Welcome to another exciting episode of The Trading Bell. This week on the show, we shall be speaking to Raj Shah. He is a derivatives specialist as we take stock of where we are as a country when it comes to the derivatives market and also demystifying how is this market performing and what are the opportunities that lie ahead. Well, before we get into that interview, let's take a look at Raj's profile.
Raj Shah is a CEO and portfolio manager at Meridian Partners LLP since 2017. He has extensive trading experience in New York, London, and Nairobi. He's also an expert in global market interest rates, equities, and FX, including swaps, futures, and options. He's a member of Bond Market Association in Kenya Executive Committee and the Nairobi Securities Exchange Derivatives Advisory Committee.
All right, Shah, thank you for joining us on the show and Happy New Year.
Happy New Year, and thank you so much for having me on the show.
All right. And for the beginners' purposes, many Kenyans do love to hear products that can make them make some money. And one of the products that has been touted as the next big thing is the derivatives market. Perhaps let's begin by just demystifying. What are derivatives?
Yeah, sure. So firstly, to kind of define what a derivative is, a derivative is a financial product that derives its value from an underlying asset. So the underlying asset could be a commodity, currency, bond, or stocks. In this particular case, the NSE has launched futures. Futures are essentially agreements or contracts between two parties whereby one party agrees to buy a particular asset at a pre-specified price and quantity on a particular date in the future. The underlying assets in this case are stocks that the NSE has on its main exchange, and they also have another underlying asset, which is the NSE index itself.
All right. So just help me understand this, Raj. If I'm buying a derivatives, what is required of me?
Sure. So, I mean, the first thing is futures contracts are actually the simplest derivatives. And so that means that the requirements for you purchasing futures contracts are going to be way simpler than they would be for other derivatives. But to kind of explain the way that an investor would go about investing in futures on the NSE, futures are traded on the NSE by trading members. So an investor would need to open an account with a trading member. And they would also need to fill in some other relevant documentation, such as a risk disclosure form. Once the account is opened, an investor would need to deposit collateral in the form of cash with the trading member. And the trading member will use that to post initial margin and variation margin on behalf of the investor. And then from that point, he's all set to trade.
All right. And this whole aspect around derivatives, once I get in, is there a limit I can put my money? Is there a maximum amount? How does it normally work?
There's similar rules as there are for stocks in terms of how investors are treated. So, for example, an investor would not be allowed to own a very, very large portion of the outstanding futures contracts if that deemed that he would have undue control over that company's shares. Other than that, there's no sort of restrictions in terms of how much an investor can invest. And because futures are traded on the exchange, an investor can, invest one day, and if he feels that the trade has kind of worked out to its completion, they can exit the contract by either selling those same shares or same contracts, same futures contracts, or by selling a different futures contracts to mitigate the risk of the original trade.
All right. And a basic question, Raj, have people made money out of this?
Yes, absolutely. So from the first day when the NSE actually started its pilot trading program, where trading members were trading capital for their own accounts, we've been seeing sort of results that the NSE has shared with us. And by and large, most investors have been able to make money by trading futures. One important distinction between futures and stocks is that it is much easier to trade futures in both directions. So it's not necessarily a zero-sum game all the time, because an investor could have a long position in stocks, and he might use futures to hedge his stocks portfolio. So that necessarily doesn't mean he loses money as stocks go up, because he's only hedging his stocks portfolio. So in short, an investor can certainly make money by trading futures.
All right. And let's talk about now the future outlook for futures, because when you look at our stock markets, they're not that dependent when you compare with other exchanges across the world. And does the product have potential for further growth?
Yes, in fact, I think that one way of actually saying this is that the outlook for futures is very, very strong, and futures will be the future of the market in Kenya. I think you touched on an important point, that the depth of markets in Kenya is smaller compared to other markets out there. Futures is something that can actually help with this, because investors can trade both long and short. This will drive more volume, because they can hedge their portfolios, and they can also speculate on both price rises and price declines. So at some point, and as the market progresses, we expect that the value and volume of futures trading will eclipse the value and volume of trading on the spot equities market. So I think that we can think of futures as the platform that the NSE can use to grow financial markets in Kenya further.
All right. And this brings me to my next question. Why are derivatives important to retail and institutional investors?
Yeah, that's a good question. Firstly, the capital requirements of trading futures are much smaller than they are for trading stocks. This is important for both retail and institutional investors. So the way it works is that if you would like to purchase a futures contract, you need to post a percentage of the total trade exposure. That's called the initial margin. So usually the initial margin is something like 10%. In certain cases, it's lower or higher depending on the risk profile of that particular security.
Yeah.
But the point is that it's a smaller amount than the total exposure that you would have to post if you bought a stock directly from the market. In a country like Kenya, that's actually important, because interest rates are relatively high in Kenya. The excess cash that is saved by only posting the initial margin versus posting the full proceeds of a stocks trade means that an investor can earn significant income from the excess cash. The second thing is something we've touched on already. That's that an investor can trade both long and short.
Yeah.
This is really important for both retail and institutional investors. An institutional investor may have a large portfolio of stocks, and he can hedge this through futures by either selling the NSE 25 index future or by selling single stocks futures. Concurrently, retail investors can speculate on price rises in the market by only having to post a fraction of the total trade exposure. So it's very important actually that institutional investors especially start trading futures now, so that they are ready for the market evolution.
All right. And as we bring this conversation to a close, any investor always weighs their risk. And of course, the markets are very interconnected with whatever is happening in East Africa, whatever is happening across Europe, or be it in the Gulf countries, has a direct effect back home. And how vulnerable are derivatives susceptible to internal and external risks? What should investors look out for when they see perhaps some certain market indications that might have an impact on the investment? What do they really need to look out for?
Yeah, I mean, that's an important question. And I think the way I would answer that is break it down into two parts. What an investor cares about are two things. The first one is liquidity, and the second is the outlook for that security. I think that both of these qualities are equally important. So in terms of the value of the security going up and going down, as you mentioned, that's going to be dependent on a lot of global factors.
Yeah.
I think at the moment, the global markets are generally in a risk-on mood. The sort of integration of Joe Biden and the control of both houses of Congress in the US by the Democratic Party has ushered in risk-on sentiment, because there's an expectation of additional fiscal stimulus. This has fed through to emerging markets, in particular emerging markets in Asia, but it's also fed through to frontier markets like Kenya. So I think at the moment the outlook is relatively positive. In terms of liquidity, I think that this is a very, very important aspect, especially for investors who look to trade actively in this market. And one thing that futures allows you to do, it allows you to enter and exit trades relatively easily. And also the cost of entering and exiting trades is not as high as it is for the spot market. Mm-hmm. This is because the exchange fees and the brokerage fees are lower for futures than they are for the spot equities market. So as the market progresses, we expect that liquidity will sort of move towards the futures market because of the lower costs associated with trading. And I think that will be an important aspect for investors as they consider new investments in Kenya.
Right. And your parting shot, we are going into an interesting season as a country. We have an upcoming election. There's chances that we might have a referendum down the line. And all this political noise could, in one way or the other, affect the stability of the economy and how the currencies perform. Do you see any risks in this, how we manage it as an economy? Or is it a market that is very mature, that investors have taken long positions?
Yeah, I mean, I think that political events in countries like Kenya are always events that investors are wary of because it's hard to predict exactly what is going to happen from these events. Historically, there's been a period of time where investors sort of don't like to take a lot of risks leading into these sort of events. But what we've seen historically is that when this happens and prices decline slightly, they turn out to be very, very good opportunities for long-term buyers to enter the market. Mm-hmm. So what we expect is that if foreign investors, for example, take a back seat in the next 18 months or so, we expect that local funds who have been increasing their equities allocation slowly will probably step in and take on the role of supporting asset prices.
All right. Quite some interesting insights there. Raj Shah, derivatives specialist, just giving us a sense of what this product is all about and the amazing future it has when it comes to alternative investments for investors. Well, that's where we take a quick break to usher in our market analysis as we take a look at how the money markets have been performing through the week.